Welcome to the Deep Dive. We're your shortcut to understanding the U.S. market today, August 7th, 2025. Our mission, simple. Cut through all that noise, the pre-market reports, earnings chatter, big announcements, and really give you the core drivers. And it's shaping up to be a really compelling day. We're kind of at this fascinating crossroads, aren't we? The market seems caught. On one hand, you've got this really strong Q2 earnings season, but on the other, these significant new tariffs are kicking in, really reshaping global trade. What stands out to you right off the bat in this, well, high-stakes environment?
It really is a tug of war, isn't it?
Yeah.
What's truly interesting is how these forces, seemingly pulling opposite ways, are creating such a, well, unique market dynamic. If we kind of zoom out, you can see maybe four primary drivers shaping today's session. First off, these new reciprocal tariffs, they're active now.
Reciprocal. Okay, that's the key word, isn't it?
Yeah.
So not just general tariffs, but hitting back at countries with their own levies on U.S. goods. What's the scale we're talking about here?
Exactly. Kit for cat, essentially. And it's not just talk anymore. This regime is active across more than 60 countries. Rates go from 10% up to 50%.
Sure.
But the really disruptive one, 100% tariff on foreign-made semiconductors. But, and this is crucial, there's nuance, there are strategic
Well, wait,
exemptions.
okay, for who?
Well, for companies moving production to the U.S. and also for key allies like South Korea, they
Yeah.
get a pass. The economic hit, though, is explicit. Look at Toyota. They're already projecting, what, a $9.5 billion impact from these new levies? And those costs, they'll inevitably get passed straight to consumers.
$9.5 billion. Wow, that's a staggering figure for just one company. So it seems these tariffs are really forcing some big strategic moves, which I guess brings us straight to Apple. That was a huge announcement, that extra investment.
It really was. And that's our second major driver.
Okay.
Apple's pivot. They just announced an additional $100 billion for U.S. manufacturing. Many see this as a very savvy response to these tariff pressures. Could be a playbook, really.
A playbook. Interesting. Do you think other big companies can actually follow that? I mean, is that kind of onshoring model truly scalable, or is Apple just in a unique spot to handle those costs?
That's the million-dollar question, maybe $1 billion now. Apple definitely has unique resources, no doubt. But you can already see positive ripples. Take Corning, right? A key domestic supplier for them. Their stock jumped, 6% pre-market? They're expanding their Kentucky plant for iPhone and Apple Watch glass. So yeah, it shows potential for domestic partners at least. Okay, third driver, corporate earnings. We've just come off a surprisingly strong Q2 season. Get this, 82% of S&P 500 companies beat their EPS estimates. And blended growth, pretty impressive at 10.3%.
82% beat, that sounds great, but I bet it's not spread evenly across the board. Where's that strength really coming from? And, what about the downside?
You nailed it. There's definitely nuance. The strength is heavily concentrated. Think communication services, information technology. You've got clear winners like Arista Networks surging because of AI demand. But then look at supermicrocomputer. Ouch. Down 17, maybe 18%. And they specifically pointed to tariff-related costs hurting their outlook. Direct link. And today's big one, Eli Lilly. Just reported spectacular results. GLP-1 drugs are driving that. They raised their full-year guidance significantly. It's a big test for healthcare, especially with potential drug import tariffs looming as a political risk. All right, fourth driver, economic data and the Fed. We're seeing that classic, almost counterintuitive dynamic. Bad news is good news for stocks.
Right. Okay, can you quickly unpack that for listeners? Why is bad news sometimes good news here?
Sure. So signs the economy might be cooling off, a bit like slower job growth figures. We've seen they actually boost the market. Why? Because it ramps up expectations that the Fed will cut interest rates soon, like September. Probabilities for a September cut are now somewhere between 84 and 93%, really high. That expectation acts like a safety net, a backstop for current stock valuations. So today's data weekly jobless claims, preliminary productivity numbers, absolutely crucial. They'll give more clues about the economy's path and therefore the Fed's likely next move.
Okay, so putting it all together, it really feels like today's trading is a kind of referendum. Can that corporate strength plus the strong belief in a Fed rate cut actually outweigh these pretty serious geopolitical and trade risks? It's a real test of investor nerve, I suppose.
Exactly right. It's a balancing act. And maybe looking beyond just today, it raises a more fundamental question for you, the listener, to think about. If these strategic exemptions and massive domestic investments like Apple's become the new price you pay to avoid damaging trade actions, how might that fundamentally reshape things, not just global supply chains, but, the basic strategy of being a multinational corporation going forward? Something to ponder.